So we'll start now. And I'll want to thank you first for joining in on Saturday and addressing our audience. And for the benefit of our audience, I'll first start with your introduction. You don't need any introduction, you have been veteran in the market. But still, for the benefit of our audience, I'll share the introduction. So today we have Mr. Vetri Subramaniam. He is the Chief Investment Officer at UTI Asset Management Company, and he joined UTI AMC as head of equity in January 2017 and assumed the role of chief investment officer in August 21. He has over 30 years of work experience in asset management industry, and before joining UTI he was the chief investment officer at Invesco Asset Management. He was part of the startup team at Invesco in 2008 and helped establish the firm's proprietary investment processes with the team. And he started his career at Kotak Mahindra after passing out from IIM Bangalore with a PG diploma in management. His experience in equity markets and investment roles at various firms from 1994 includes Kotak Mahindra, SSKI, and Motilal Oswal. He was also one of the founders of Sharekhan.com, where he led the research and content team. And he has also been an advisor to a UK based hedge fund on its equity investment in India from 2003 to 2007. So thank you, Vetri sir, for joining in and addressing our audience.
Thank you, Aditya, for having me, and delighted to be here and be able to address all the investors at Wealthy Nivesh. It's a delight to have this opportunity.
Thank you, sir. So, sir, I'll first start with a very obvious question. There has been a lot of talks on mid and small caps and their current valuations. And these indices have given almost 60% returns in the last 1 year. And SEBI also indicated some froth building up in this space. So, how are you as a fund house looking at this space and your views on this?
Yeah, sure. So I think, Aditya, I don't want to use a label because, what is cheap and what is froth is a completely different issue. But, I think we have been highlighting that there are concerns about valuation in the mid and small cap space for some time. If anything, you could argue that we have been early, and very early in my career, one of my bosses told me, he asked me a question. He said, in the stock market, what is the difference between being early and being wrong? And I was thinking about the answer, and even before I could give the answer, he said, there is no difference. So,
So true.
so I don't fully agree with that answer, but it just provides context that in the stock market, there is no difference between being early and being wrong. So, I was looking at our own monthly commentary that we put out. And right from September 2023, I can see that we have been highlighting that we were concerned about mid and small cap valuations. And from September 2023 till the peak, which happened few weeks ago, mid and small caps actually went up 30%. Right. So that's the answer to the question. What's the difference between being early and being wrong? There is no difference, right? Because we thought it was expensive. It went up further 30%. But, my simple point, Aditya, is valuations are not like a school bell. When you are in school and there is a school bell, the school bell has a very definite meaning. In the morning, when the school bell rings, it means you have to assemble. In the evening, when the school bell rings, it means you have to disperse from school. It has a very definite meaning. Valuations are not like a school bell. They can be observed. You can derive certain interpretations and messages from it, but it is not a school bell. Just because valuations are cheap doesn't mean from tomorrow market will start rising. Just because valuations are expensive doesn't mean from tomorrow the market will start falling. So you have to understand that. Fact of the matter is that valuations are expensive. There is no other way to interpret it. And, as I said, sometimes it's useful to just look at the data. So I will just pull up one particular slide. This is from the monthly deck, which, we sort of discuss every month. I won't run through each and every deck, but I'll just take you to one interesting slide, which will put this in context. So, this is a simple slide which shows over the period of 1 year, which is from March 2023 to March 2024. You are absolutely right. You can see as per the data here, Nifty Next 50, Nifty Mid Cap 100, Nifty Small Cap 100, and finally Nifty Micro Cap 250, you can see how their aggregate performance has been over a 1 year period. Nifty went up 31%, Nifty Next 50 went up almost 60%, Nifty Mid Cap 100 60%, Nifty Small Cap went up 72%, and Nifty Micro Cap went up almost 96%. Right? Now, when it went up by these numbers, we can break it down into how much was due to earnings growth and how much was due to the PE multiple going up. The area that you see in the dark color is the area where it has gone up due to earnings growth, and the balance is the increase due to PE multiple expansion. Simple point that this chart is showing you is that the yellow in most cases is more than the black, which means the bigger contributor to the increase in stock price is coming from an increase in the PE multiple rather than from earnings growth. Now, this data shows you earnings growth in mid cap and small cap. Yes, it was better than Nifty for the last 1 year. Will it be better than the Nifty for the last 5 years and 10 years? Nobody knows. Historically, the Nifty has always had better earnings growth than mid cap and small cap when you look over 5 year and 10 year periods. That is the history. Yes, for the last 1 year, it has been better. But the bigger contribution to stock price is from PE multiple expansion. The message from this is that one needs to be cautious. One needs to be cautious because relative to history, this level of valuations for mid cap and small cap, which are actually at a premium to the large cap, are highly unusual. And therefore, as investors, we need to keep this in mind when we are investing. So slightly long answer, but I thought it's useful to, just put that slide over there and give some data so that people can understand where we are coming from when we say that you need to be cautious. One final point I will also make, Aditya. Valuations is all about probability. When the probability is in your favor, the chances of getting a better outcome are superior. When the probability is not in your favor, the chances of getting a superior outcome are lower. It is not 0-1, right? So is there a small probability that mid caps and small caps may outperform large caps over the next 1 to 3 years? I cannot say it is zero probability, but it's a very low probability. And therefore, you need to take cognizance of this in your investing decisions.
Absolutely. And it gives a lot of context on where the prices have moved, whether it is from the earnings growth or just the expansion of PE multiple.
Correct.
Absolutely. And sir, SEBI also asked all the fund houses to do a stress test disclosures in this space. But the usual investors don't understand the results that come up or the language that is there. So could you help us understand the significance of this disclosure? And I'm sure these all the fund houses do this exercise internally as well. But what is the significance of putting it out in the public?
Yeah. So, I think unfortunately, when you use certain terms, then obviously people sort of, worry about it. I think SEBI had its own thought process about why they felt, this data should be provided and why they felt that they have particularly used the word stress. But, the way I would think about this is that when you go, I hope many of your investors, if they are the same age group as me, I'm 54, hopefully they do an annual health checkup, right? Now, when you go for an annual health checkup, there is one test that they ask you to do, which is known as the stress test, right? Where they make you walk on the treadmill, and then they will take the speed up, then they will increase the incline. Now, just because you are doing a stress test doesn't mean there is something wrong with you, right? That's the first point to understand. It is only a test so that you can be preemptive, just in case it may be able to identify कि हाँ शायद कुछ problem है. The fact that you are doing a stress test is a good thing. It doesn't mean that something is wrong. So that is point number one. Now, I also want to say, and you sort of in a way asked this in your question as well. See, many of us, certainly as UTI, I can say this, we have always looked at what is the liquidity profile of our portfolio, right? So we had a slightly different methodology because there is no one methodology to calculate any number. But for many years, we have had a practice of calculating what is the amount of liquidity which can be generated from our portfolio in a 1 day period and over a 3 day period. And we also look at what is the concentration that we have in terms of investors in our scheme. How many investors, I mean, top 10 investors, what is the AUM they have? Top 25 investors, what is the AUM they have? Top 100 investors, what is the AUM they have? Why do we do this? We have been doing this for many years. We have been doing this so that we know what is the liquidity of the portfolio. And we also know, is there any concentration on our liability side that we need to worry about? Just for argument's sake, if one person owns 25% of my portfolio, it's a little bit of a problem, because on a single day, if he decides to redeem, I will need to generate that much liquidity in a single day. So this data is put to our investment committee every month. Top 10, top 25 investors, liquidity profile, 1 day and 3 day. And we don't do it only for our mid-cap scheme. It is done for every equity scheme that we run, because it is important to know the liquidity profile and the liability profile of every scheme. So we have been doing it
Right.
for many years, but it was internal to us. I think what now SEBI has asked, and I always think disclosure is a good thing. जैसे कि आप बोलते हैं ना कि धूप में किसी चीज को रखेंगे, so it actually sort of gets cleaned up. So as they say,
Mm.
sunlight is the best disinfectant. So it's fine. SEBI is now given a standardized template. The template we use was slightly different. What they have given is slightly different, but it shows more or less, I would say, it answers the same question. It
Sure.
shows how much liquidity can be generated by this portfolio. If 25% of the investors were to redeem their money, how much can be generated if 50% were to redeem their money? How many days it will take you to generate that kind of liquidity? अभी ऐसा भी नहीं है कि all the 25% will come on a single day. I'm giving you my example, but in UTI, for example, we have 5,30,000 investors in one scheme, which is our mid cap, and we have about 3 lakh investors in our small cap scheme. ऐसे कभी नहीं हुआ कि 3 lakh investors
Right.
on a single day come to our office. If they come, we'll be very happy. We'll greet them with some chai, coffee and snacks. But ऐसा कभी नहीं हुआ कि 3 lakh investors come to the office and say, we want to redeem. So it's a very extreme case, 25% and 50%. But in the interest of standardization, the AMFI and SEBI decided that you show, if 25% of your investors come to redeem, how many days it will take you to provide the liquidity? If 50% come to redeem, how many days it will take you to redeem and provide the liquidity? Secondly, top 10 investors, what is the percentage of your assets which
Mm.
belong to them? And in our
Right.
case, it is, about 1 to 2%. So it's a very small number. So that is exactly the data that we have provided. And please think about it as liquidity of the portfolio. The word stress, people
Right.
worry about it. But as I said, think about stress tests that you do on the treadmill. It's a good thing to do it. There's nothing wrong about doing it. Doesn't mean something is wrong, but it's
Right.
a preemptive thing. So that is why they use the word stress test, but just think of it as a liquidity test.
My only idea was that it should not create stress in the investors' mind. And
No, no.
I
See, thankfully, so far, whenever I have done stress test, the results have always been good. But I must tell you that every time before I climb on the treadmill to do the stress test, you do feel, I hope it's going to be okay. So that's
right,
fine.
right. And I was looking at the results yesterday, and your mid and small cap portfolios are fairly placed compared with some larger size funds. And the number was about 4.2 to 4.3 days for 50% of the portfolio. So, can you help us understand the significance of this number? This 4.2 to 4.3 days, 50% of the portfolio can be liquidated.
Yeah, so if 50% of our investors were to redeem, and not 50% of investors, investors who own 50% of the portfolio,
The
if
portfolios,
they
right?
were to come and redeem, then it will take us 4 days to be able to raise the liquidity. Now, theoretically, we can also raise the liquidity faster by selling what is liquid very quickly. But
Right,
in the SEBI calculation, what they asked us to do, which is a good methodology, they said, ऐसा मत कीजिए कि you sell what is liquid and leave what is illiquid in the portfolio.
right,
You presume that you will make your sales on a pro rata basis across the portfolio and then provide the number. So that is what we have provided as the number. But again, just to give you a historical context, this number is presuming that 25% and 50% of my investors will come on a single day to redeem, right?
uh,
What is my past experience as UTI, and we have been in business for 60 years, what is my past experience of worst case redemptions which came in a single month. In a single month, we have never experienced more than 2% of AUM as redemption. मतलब
Right.
पूरे महीने में it has not been 2%. So when they are doing this 25% and 50%, that is the reason why they perhaps said stress. Because
Right.
normal liquidity event would have been 2% and 3%. And आज के दिन पे, 2% is not a challenge at all. Also, one of the things I should point out, Aditya, which has changed compared to 20 years ago, is that today, on a monthly basis, my small cap and mid cap scheme, and I'm sure the number may be same or even better or worse for some other fund houses, 3% comes in as cash every month through SIP. So,
Right.
if I actually think about 2% redemption over an entire month, वो तो SIP से ही we'll be
ऐसे ही
able
पैसे
to
आ रहा
fund it. So there are many moving parts, but yeah, this is
है.
the way
Right.
to understand the number.
Right. And even I believe that there's a lot of liquidity that is being created in the market in terms of hybrid category, balance advantage funds. Whenever the markets go down, they pull in the money. Then there
Absolutely.
is EPS money, NPS money that is coming in.
Absolutely. See, the mutual funds, and I'm referring now only to mid cap and small cap schemes. Mid cap and small cap schemes, if you only look at those two categories, own only about 5 to 7% of the total market cap of all mid cap companies and total market cap of all small cap companies. Right?
Right.
So who
Right.
owns the rest? Who owns the rest? Other mutual fund schemes also own mid caps and small cap. मतलब कि जैसे आपने बोला balanced advantage scheme, multi-asset scheme, maybe even a large cap scheme can have 10% in mid and small cap. Flexi cap
Absolutely.
schemes have 10% in mid and small cap, maybe more they have. So this data is only looking at what if people leave mid and small cap scheme.
Hmm.
लेकिन वो लोग जाएंगे कहाँ? Unless you are saying वो म्यूचुअल फंड छोड़ के पूरा चले ही चले जाएंगे. But
Right.
I think let's be practical. We are talking about Amrit Kal, Viksit Bharat, 20-year journey. People are investing also with a very long-term thought process. So I think this data should give people reasonable comfort that we are reasonably well placed. Valuation is a separate issue.
Absolutely.
It's a separate issue. But
Right.
liquidity point of view, I think the fund industry is reasonably well placed today.
Right, sir. And sir, this question is from the perspective of a new investor who is investing for the first time in equity markets. And I believe there was SEBI also raised this concern that new investors should not suffer at the expense of old redeeming customers. So, what categories of mutual funds would be prudent at this time for any first time investor entering into the markets?
So let me just clarify. First time investor benefiting at the expense of longer term, we have to understand that thought process very carefully. देखिए, when you were in school, I was in school, my teacher very early in life taught me that this proverb, early bird gets the worm.
हाँ.
मतलब कि जो अर्ली करता है उसको बेनिफिट मिलता है. तो दिस इज अ लॉ ऑफ नेचर. This law of
Right.
nature cannot be outlawed. Let us be very clear. Having said that, what SEBI meant when they said early mover advantage is basically ऐसा नहीं होना चाहिए that the first investor who comes to you for redemption goes away by the fund liquidating all the positions which are liquid and only what is illiquid is left in the portfolio. That is why I said their methodology that Amphi prescribed for us presumes that we will sell the portfolio
Pro
pro
rata
rata.
basis.
Liquid shares will be sold alongside illiquid shares. So that is the way in which the first mover, sort of issue has been addressed, and that is addressed in the methodology of the calculation itself. As far as your other concern, question is concerned, even yesterday I was asked this question. See, whatever is the I'm presuming, जैसे कि आप wealthy निवेश में you are talking to your customers, there
Yes.
is some financial goal that the customer has. To reach that financial goal, they need an asset allocation plan, and you have created an asset allocation plan for them. Obviously, you will sometimes also determine what is tactically attractive. You may do a little bit of rotation, but
Right.
there is a plan, there is an asset allocation, and you are investing as per that. My recommendation is that you must be guided by your asset allocation plan, not by market. Election के कारण नीचे आ सकता है, market budget के पहले ऊपर जाता है. Those are all not considerations for asset allocation. So if your asset allocation to equity is higher than the plan, reduce it. If your asset allocation is lower than your target, increase it. Within your equity allocation, if you are overexposed to small caps relative to your plan, reduce it. If you are underexposed, increase it. If you are doing SIP or STP, then why you are bothered? You are anyway investing through SIP for 10 years. Over 10 years, sometimes you may buy the market more expensive, sometimes you may buy the market extra cheap. When it is extra cheap, you will get more units. When it is extra costly, you will get less units. Over time, आपको average पे मिलेगा. So you should be able to make return out of it. So my simple advice to investors, SIPs you should continue. Lump sum, be careful in small cap and mid cap. Be guided more by your asset allocation framework. And जो asset allocation framework है ना, वो एक बहुत simple principle है. It is like a speed limit, right? If most of your customers are in Bombay, at some time they would have driven on JJ flyover. And JJ flyover is a very strange flyover in Bombay because it says speed limit 30, right?
Right.
But the way you should think about asset allocation is the way you deal with the speed limit. If you enter JJ flyover at 10 kilometers an hour, which happens at 9 a.m. because there is already a traffic jam, then you have an opportunity to raise your speed to 30 if the traffic is light. If you enter JJ flyover at 10 p.m. when there is no traffic, you may enter at 50, but you reduce your speed limit to 30 because that is the law. Correct?
Right.
Similarly, asset allocation is telling you what is the speed limit. If you're above the speed limit, reduce. If you're below the speed limit, raise it. That is the way to invest. Not कि अभी ये होने वाला है, वो होगा. And I would actually say, please don't invest because somebody says अगले 25 साल में ये होने वाला है. That is not the reason to invest. You should invest because your investment is aligned with your financial goals, with your speed limit.
Sure, sure. And we always say that the returns come from the asset allocation. And people just
Absolutely.
talk about keys. This fund has this alpha, this fund has this alpha. But mostly your returns come from asset allocation, then it's just plus minus delta.
Exactly.
And sir, though you have already addressed it, looking at the events, not looking at the events, but we get it's a very popular question. Elections are underway, and everyone talks about this strategy before and after elections. So, how do you, as a fund house, see this event? Is there any risk that you take into account, or how does your strategies or sector allocation change based on this event, or it does not change at all?
So, see, Aditya, I have been investing professionally since 1994. And therefore, I have seen the market in multiple elections 96, 98, 99, 2004, 2009, 14, 19. All I can tell you is that, first of all, in many cases, maybe not this year, but in many cases, it is first of all impossible to know election में कौन जीतेगा, कौन हारेगा. This is true not just of India, it's also true, honestly, of many countries across the world. I'm not including countries like China or Russia where there is no election, so to speak, so it doesn't matter. So, first of all, it is very difficult to predict the election. Secondly, it is very difficult to predict how the market will react to the election. 2004, the market was down 17% after the election result. 1 year later, the market was up by 30%. 2009, the market was up 20% on the day of the election result. 18 months later, it was 30% below that day's value, right? So I have learned the very hard way in life कि don't base your decisions on election में क्या होगा. कभी आपका लॉटरी टिकट लग जाएगा, you may be correct. कभी आपका लॉटरी टिकट नहीं लगेगा. That was a classic example of 2004-2009. That was also what happened in 1999 and 1996, where the election result was unexpected, but the market actually responded very positively 6 months later. So I would again say be governed by your speed limit and don't be focusing too much on things like election. The other additional point I will make today on Zoom, of course, allows us to do a poll as well. I'm not sure the outcome of the election is going to be different from, what all the election, what all the TV channels are showing as likely results based on opinion polling, or what we may find out if we do a opinion poll here. So if there is not going to be a surprise in terms of who is the government, the policies have also been reasonably well articulated. Fiscal deficit 5.1, then 4.5, then we will try to maintain the quality of expenditure on capex, at least as far as government is concerned. Then there is continuity of policy. So I am not sure that anything really surprising is going to come out of this election that we need to position for it. And my past experience is trying to position for election is like a lottery ticket. Sometimes you can feel happy, sometimes you will get slapped in the face. Better not to act on it.
Right, right. And what we believe that the consensus of the results is already somewhat factored in in the
Yeah,
market.
absolutely. Yeah. I think, see, 2019, what had happened is that the election results of that October-December period raised some concerns about what will happen in the general election. But this time, I think all those concerns went away when the results came. So actually, if you see, that's why December, January markets were very strong. And I would say
Right.
that strength of December, January was the markets responding to the fact that, we are now discounting the election outcome.
Absolutely. Absolutely. And sir, now I'll come to the view of your fund house on different sectors. So, which are the ones you are currently overweight and which are the ones you can underweight? If you can throw some light on that.
Sure. So, Aditya, the first thing I would point out is that UTI may, what is common is that we have one investment process which is called score alpha, but individual strategies may have very, very different positioning, right? And
Sure.
that different positioning is a function of what is the mandate of the scheme, and secondly, what is the underlying investment philosophy with which that fund is being managed. So there can be very big differences between fund positioning when you look between different schemes. Like today, we may have some schemes which have zero metal exposure. We have some schemes which are overweight on metals. We have some schemes which are overweight on pharma and healthcare, some which are actually underweight on pharma and healthcare. So let me just answer this question differently. We run many sector funds. So one of the questions we get asked is, where is the tactical opportunity for a beta investment opportunity? Beta is you're
Sure.
just trying to make a market return. It's not about the alpha. So that is typically in sector and thematic funds. Today's date, if you ask me, we think the best opportunity for absolute returns is in the banking and finance space. Banking and finance sector in general has not done much in terms of price performance for the last 1 to 2 years. The quality of the banks and financial services companies' balance sheets is fairly good. As the economy grows, they are natural beneficiaries of the growth in the environment. There are many challenges they are grappling with. Some relate to regulation, some relate to tightness in the economy. But I always say where there is challenges, that is where there is investment opportunity. तो पीपल विल टेल मी, अरे रिपो रेट नीचे आएगा तो बैंक्स का निम कम होगा, आरबीआई इज गेटिंग वेरी एक्टिव. आई एम सेइंग दैट इज व्हाई, बिकॉज ऑल these challenges are there is an opportunity in the sector to buy it at a valuation which is reasonably attractive. So from an absolute perspective, banking and financial services fund is one that we are quite positive on. The second fund which we are positive on is the pharmaceutical healthcare fund. Here, the argument is slightly different. We were positive on this even 1 year ago. The sector is among the top 3 or 4 sectors in terms of performance over the last 1 year. So, valuation comfort is not as high as it was 1 year ago. But I still think the sector is in a reasonably good place. Companies are focused on addressing their internal issues, improving return on capital. Growth outcomes are quite comfortable. In fact, if you see, I would say branded pharmaceutical is growing faster than FMCG, and their return on capital is actually quite comparable. Generic market pricing was very, very bad 2, 3 years ago. It is still a challenging situation, but it's no longer falling 30% every month. So, there also the pressures have eased. And as far as diagnostics and hospitals are concerned, there is a section of the population which has the ability to spend, and therefore they are willing to pay on high quality services, and therefore that part of the sector is benefiting. I also think it's a little bit of a defensive play. So given the way the market has behaved over the last 1 year, I think the defensiveness of the sector will also contribute. So these are two sectors where we are sort of still positive. The other
Sure.
sector where we used to be very positive all the way from December 22 was automobile. As you're aware, we run a fairly large transportation and logistics sector.
Right.
But to our mind over there, most of the story has played out.
Hmm.
So incrementally, that is not a sector where we are hugely excited, because last 2 years you have seen significant improvement in growth of both four-wheelers, commercial vehicles, and tractors. Only two-wheelers is still running about 10 to 15% in volume below previous cycle peak, but everything else has now caught up with the cycle peak. So T&L, we are no longer as positive as we used to be 2 years ago. It's not a fund that we are currently sort of recommending as a beta opportunity.
Sure, sure. Thank you so much, sir. And now, moving from equity, we would like to understand your views on the fixed income market. We are having a flattish yield curve with 1 year GSEC at 7.06 and 10 year at 7.04. So how do you look at this yield curve, and is there any opportunity to lock in higher yields, looking at the interest rate cut cycle?
Sure, sure. So two things to keep in mind, Aditya. One is there is a very fundamental change happening in the bond market. See, foreigners have been very involved in our stock market for many years. Right from the time I started my career in 1993, foreigners started investing in Indian equities in 1993. At the peak, they actually owned more equities than Indians did, because they were almost 24% of equities, whereas direct retail plus mutual fund used to be barely 10%. Today, foreigners are about 20%, and direct plus mutual funds have reached about 14-15%. But in the bond market, foreign presence was very, very limited. They used to have some exposure, but it got opened up only in the last 10 years. And I think one of the big events which has happened recently is the inclusion of Indian bonds in global bond market indices, which is causing more foreigners to look at the market now because it's part of their indices. In the last 5 months, from October 23, when JP Morgan made the announcement that India will come into the JP Morgan bond index from June, and every month the weightage will keep going up over a 12-month period, you have actually seen $10 billion of foreign money come into Indian bonds. I
Right.
think by the time you reach December 2024, this number should reach about $20-25 billion of bonds. Now, structurally, this is very positive, but don't presume that because the money is coming, bond market will go berserk. Because see, bond market is managed by RBI. It is managed by RBI from the point of view of stability. And unlike SEBI, RBI has a balance sheet. And RBI is always willing to take the other side of the trade. So in
Right.
2021, when government needed to borrow and there were not enough people to fund government, RBI funded the government. Today, many people come and say, we want to buy bonds. RBI will say, okay, I will give you the bonds because it's already lying on my balance sheet. So some part of the benefit of this flow is already reflected in the yield, but certainly more and more money coming will create some upward pressure on downward pressure on bond yield, which is good for investors. So maybe
Right.
7%, there will be pressure for it to eventually come below 7%. But the other question that you made, rate cuts. Our view is that RBI is now saying my inflation target is 4%. It is not 4 plus or minus 2%. It is 4%. If the target is 4% and economic growth is already 7.5%, maybe even closer to 8%, there is no pressure on RBI to cut rates today. Why should they cut? You are running at
Yeah.
5.2% inflation. Target is 4. Growth is 8%. This is the opportunity to go to 4%. That is our interpretation of what they are saying. So rate cuts are possible, but our sense is it will happen only maybe September to December. Maybe 1 to 2 rate cuts are possible. So the repo rate from 6.5 could go down to about 6%. Maybe by March 25, the 7.05% of the 10-year bond, it could go down to about 660, 670. So
Right.
if you are buying a 10-year GSEC yield, GSEC bond, the bond is giving you 7.05. 30, 35 basis points can be the improvement in the yield. So that can add about 2% to your holding period return. So maybe you can get 8.5 to 9% by buying a 10-year GSEC over a 1 year period, which is a good number, but I would say not so attractive, because in the past, when people have seen interest rate down cycles, 2018, 2013, first of all, the rate had gone up to above 8% and 9%. And from there, it came down to 6% and 5%. So people ended up making 14, 15% CAGR.
Right.
Right now, the ability to make 14, 15% CAGR is not there. We are discussing basically you can make about 8 to 9%. It's a good return for fixed income. So our suggestion would be either you can look at schemes like a 10-year, constant maturity fund, which will give you the ability to play this. But our bigger comfort is more with actively managed strategies like the short duration fund, our corporate bond fund, and the PSU bond fund. Reason why these three are attractive is that their maturity is about 3 years, and most of the foreign money which comes into the bond market is going to come in bonds which are in the 3 to 5 year bucket, not the 10-year bucket. So from that point of view, my top recommendation would be short-term income, short duration fund, corporate bond, which again is maturity of about 3 years, and the PSU fund. Somebody who wants to aggressively try and play for a 1 year return, which could be about 9% if you're lucky, then you look at the 10-year constant maturity.
Sure. Sure. And so now I'll come to the last question that we have from the audience. And as a wealth manager, also we constantly think about asset allocation and understanding the risk profile. So, what is your current asset allocation in the portfolio, and how do you decide that?
So, I'll answer that two ways. See, first of all, honestly, Aditya, I think looking at any one person's asset allocation has no meaning, because
Hmm.
every person's asset allocation is a function of their risk appetite, their income flows, and what their spending needs are. So, I always tell people the biggest investment that I am making right now is not even in my asset allocation, because I have two children who are studying in the US, and my biggest investment is in their education, but it is sitting in
Sure.
my PNL account. It is not sitting in my balance sheet. Right. So I think what you do in terms of asset allocation is very, very personal. There is no one answer. But the model that we run at UTI, because that is the model which feeds into our balanced advantage and into our multi-asset fund. Right now, they are both holding their equity exposure at about 50, 52%, compared to a low of 30 that it can go to and a high of 80 to 90 that it can go to. So I would say it is
Right.
somewhere in the middle. And I think it is, a reasonably appropriate number. So that's what I would say, in terms of asset allocation. And one final thing, I've written about this publicly as well. When I started my career in equity markets, I said, I'm a complete equity guy. So I can afford to have all my money in equity. And I did have all my money in equity. And between 1998 and March of 2000, my portfolio went up 4 times. Right. I was very happy. I did not have any children. I was working. My wife was working. I was living in a house, because at that time my parents were in Bombay. So I was living in my parents' house. So I did not have any rental consideration as well.
Oh,
And life was going along very well. Right. In 1 year, my life completely changed. First, the market collapsed and my portfolio collapsed 80%. Right. So if my
okay.
portfolio went from 25 to 100, from 100, it came down to 20.
20.
Okay. I lost my job. I had a baby, right? My parents decided to leave Mumbai, so I didn't have a house. And my wife had actually stopped working, saying there is a baby at the house. And then my wife went back to work, actually saying, okay, if you are going to lose your job, better at least I have a job. And the first thing that I learned from that is that, boss, asset allocation is required.
Right.
Because it's an uncertain world. It's not just about your portfolio, it's about your income, it's about your job. Is there a child? Is there a house? Is there a rent? Right? So it's very personal to every person, and I would say every person has to take what is
Yes.
right from. So personal finance is personal. There are no standard rules.
Absolutely. Absolutely. And no standard rule or formula can be applied to everyone. And that's why, sir, we take our job very seriously, understanding the risk profile and then advising the right asset allocation to our clients based on their goals. Um, thank you so much, sir, for joining in and so simplifying the terms, simplifying the stress test, the markets, the valuations, the fixed income markets. It's been a pleasure hosting you, and we would like to do more such sessions with you and your team in future.
Perfect. Thank you so much, Aditya. I hope your investors also found the session useful and certainly look forward to connecting and wish everybody a wonderful weekend.
Thank you, sir. Thank you so much. Thank you.
Thank you. Thank you.